you all have an idea about this particular standard. So this standard, I'm predicting it will it might appear in one of the papers. It might be corporate reporting or it might be a financial reporting. You see, it's those standards that are performance standards. We have some standards that we call performance standards, some standards that will measure the performance of a company, and earnings per share is one of them. So mostly in the exam, you are going to see maybe at least 3 of non-current asset standards relating to what? Non-current assets. It can be non-current asset held for sale, impairments, leases, all those assets, investment property, and all those standards that are relating to an asset. But you are also going to see maybe some of the liability standards, which is the provisions, financial instruments. You can see one of those ones or two, or you see what we call the performance standards, which earnings per share is part of them. So from August, I'm sure from August corporate reporting, they haven't examined earnings per share up to now. Financial reporting too, I'm sure the last time that earnings per share came was maybe, I don't know, but that one too was too, it's up to 3 sittings now. They haven't examined the earnings per share. It is likely that it might appear in the exam. All right, we all know what we call earnings per share. When you have a company, the motive of you having a company is to make profits. The company is a limited company. It means that you're going to make profit for the owners, who are the shareholders. So these shareholders, they become owners of the company through subscription to the company shares. They become owners of the company by acquiring the shares of the company. So if this is the number of shareholders that we have, and this is the number of shares that the company is having currently, whenever we made a profit, assuming you want to share the profit among the shareholders or among the number of shares that we have, what will be the profit per one share? That is what we call the earnings per share. So if the profit that a company has made for this year is 20,000, and the number of shares that a company is having, number of shares outstanding is 50,000. So it means that if we want to share the 20,000 among the number of shares that we have, one share will be getting what? 0.5 Ghana cedi. So for every share, the earnings is 0.5 Ghana cedi. That's what we call the earnings per share. That's what we call the earnings per share. The question can say number of shares outstanding. The number of shares outstanding is the number of shares that the shareholders have subscribed to, or the number of shares that the company has issued. And that is the number of shares that has been bought. Sometimes they can say authorized shares. Authorized shares is the maximum number of shares that the company can issue. So they can give you authorized shares of 20,000 and they say the shares in issue is 15,000. The company has the capacity to issue up to 20,000 shares, but they were only able to sell only 15,000 out of them. So the 15,000 is the shares subscribed to or the shares in outstanding. So whenever you are giving the shares, pay attention. We use the shares in issue, the shares that the people or the shareholders have subscribed to or have bought, not the total number of shares that the company can issue. So the earnings per share is, we made a profit, and this is the number of shares that we have. This is the number of shares that is giving us as profit. So assuming you want to share the profit over the shares, one share will be getting how much? That is the earnings per share. And the earnings that we are talking about is the earnings for the owners of the company. So preference shareholders are not owners of the company, so their dividends will be taken away from the earnings. So the earnings is the earnings attributable to what? To the ordinary shareholders. Then divided by the number of ordinary shares in issue or outstanding. That is the earnings per share. So basically, what we know is earnings per share is calculated as earnings attributable to ordinary shareholders over the number of ordinary shares. This is what we know. This is what we know. Okay. This is what we know. We do this with the assumption that there will not be any additional issue of shares during the year, and there will not be any bonus issue. The assumption is that the shares at the beginning of the year is the same as the shares at the end of the year. So if the shares are 20,000, it means that from the beginning to the end, that is the number of shares that we have. So if we have made a profit of 10,000, it means that we have used 20,000 shares money to generate what? A profit of what? 10,000. All right. But mostly, this is not the case. The company can be in operation from January to June or July, from January to June, then they will issue additional shares. If they issue additional shares, how are we going to calculate our earnings per share? We issue additional shares on July to December. So you can see that the first 20,000 shares was there from January to December. But the second one, which is now the 2,000, was there from only July to December. It means that the profit that we have made for the year, the 2,000 contributed only 6 months to that particular profit. Let's take it to the real life situations. Okay. Both of us, we were going to work for someone. Okay. 3 of us, we are going to work for someone. So we are going to work for someone and we have already spent 5 hours before additional 2 people join us. So we have spent 5 hours already, 3 of us, 3 people, we have spent 5 hours already, and additional 2 people join us. And the total, additional 2 people join us, additional 2 people joined us. So 2 people join us. Okay. We have spent 5 hours before these 2 people join us. And at the end of the day, we have used 8 hours to work. We have used 8 hours on the work. So the question now is, if they have given us what? 2,000 for the 8 hours, are we going to share the 2,000 equally among the 7 people? Are we going to share the 2,000 equally among the 7 people? What are we going to do? What are we going to do? We are going to find... Yes, okay.
They have to apportion it with the number of works the people have worked.
Okay, so it means that first 5 hours will be shared among 2 people, 3 people, the first 3 people, isn't it? So that will be, give us how much? 5 over 8. 5 over 8 times 2,000 is how much?
1,250.
Okay, so it means that the first 1,250, the 2 people will not take part, isn't it? Because they haven't been there before we work for the 5 hours. So they cannot enjoy the first 5 hours work that we have done. The money that we are going to get for the first 5 hours, they cannot enjoy it because they were not there before that work was done. They can only enjoy the 3 hours, which is the additional hours that we have used when they join. So it means that the first 5 hours, the money that we are going to get for it, the 2 people that joined after the 5 hours will not have portion of it. They'll have portion of the one that's what they have participated in, which will be the 3 hours money. That is the money that they are going to have part of. It's just like partnership. When we have made a profit before a partner joined, the profit that we made before the partner joined, he's not going to have a share. The same way applies to what? Or the same principle applies to the earnings per share. So if we have 20,000 shares at the beginning, after 3 months, the company has issued 5,000 shares. Okay, you see that the 20,000 is going to be there for 12 months, isn't it? But then 5,000 will be there for how many months? 9 months. So the profit that we have for this year, this 5,000 has contributed only 9 months to that particular profit. That is what we call the earnings per share. So that is the idea about the earnings per share. So the earnings per share, we have 2. The standard, which is the IAS 33, give us 2 type of what? The earnings that we are going to calculate. The first one is the basic earnings per share. which is what we know, and we have what we call diluted earnings per share. So we are going to look at them one by one. Basic earnings per share. The basic earnings per share is the one that we know. But diluted earnings per share, the diluted earnings per share is just like, okay, currently you have 12 houses. You have 12 houses and you have 5 children. You have 5 children and you have shared the houses among them. Okay, but you still have a wife. You still have a wife. And the wife, she's still fresh, she can give birth, and you can also give birth. So it is likely that you might end up giving birth in addition to the 5 children that you have. So the question now is, if your wife should give birth in the future or in 2 years' time, if your wife should give birth, would the 5 children be getting the same portion of the houses that you have given to them? No. So it means that if your wife should give birth, it means that the manner in which the houses is going to be shared will be changed or will be different. That is the idea about a dilutive earnings per share. Okay, you have a convertible instrument and you are saying that in 2 years' time it will be converted. The convertible instrument is here. Assuming that the instrument has been converted, what will be the effect on the earnings per share? That is what we do. So the dilutive earnings per share is something like an assumption. It's just like a notion. What will be the effect of the earnings per share if this condition that is existing today is exercised in the future? That is about the earnings per share. That is about the dilutive earnings per share. You currently have 6 children. You still have a wife who is fresh. You are sharing your 12 houses among your 6 children currently 2-2. The question is, if your wife should end up giving birth again, what will happen to the apportionment that you have now? It means that the children will not be having 2 houses each again. The one will now bring in how the houses will be shared. That is the dilutive side of the earnings per share. So the earnings per share, we have 2 ways of calculating, or we can calculate earnings per share for 2 different companies. The first one is basic earnings per share can be calculated for a single entity. If it is a single entity, earnings per share is calculated as the earnings attributable to the ordinary shareholders divided by the weighted average number of the shares. So the earnings attributable to the weighted average, earnings attributable to the ordinary shareholders divided by the weighted average number of shares. Earnings attributable to the ordinary shareholders. What we are saying is that if there is any irredeemable preference dividend, it will be taken away from it. If you count to single entity, dividend of preference shares, redeemable preference shares are treated as what? Financial liability. So the interest over there will be charged to profit or loss as a finance cost. So whenever you are given a preference or redeemable preference shares, the interest or the dividend on them has already been charged to profit or loss, because preference shares are treated as what? A debt instrument under financial instruments. So the interest on it is already charged to profit or loss. It is only in redeemable preference shares that we take their dividend to statement of changes in equity. So the figure that you are going to subtract, the dividend that you are going to subtract from your earnings, is dividend of irredeemable preference shares. When you are giving preference shares, the dividend has already been charged as a finance cost to profit or loss. Take note of that. The dividend that you can subtract before you get the earnings attributable to the ordinary shareholders is the dividend of irredeemable preference shares. The weighted average number of shares, we are going to look at how we calculate that. The second one, the question can also ask you to calculate this for a group, a parent or a group account, which you call the parent. So the earnings per share is always calculated for the parent company. How do we do that? So the basic earnings per share is calculated as the profits attributable to the parent company or the shareholders of the attributable to the parent shareholding divided by the number of, or the weighted average number of shares. Okay, so our pen is falling, divided by the weighted average number of shares. Take note of that. How do we calculate the profit attributable to the parent company? Okay, the question can give you the group profits. The question can give you the group profits. And you have to know that out of this group profits, the profit relating to the NCI is part. So you take the NCI portion from the group profits, and you also take the dividends of irredeemable preference shares. The parents might be having irredeemable preference shares, so you take the dividend from it. Or the question can give you the group statement of profit or loss, and they will show profit attributable to the parents and a profit attributable to the NCI. We take only the profit attributable to the parents. So we are going to pick a question like that so that we can solve that also for the parents and also the basic earnings per share. All right. Let's get into the basic earnings per share. Basic earnings per share. Another basic earnings per share, we are going to look at shares issued at a full market price. We are going to look at what we call a bonus issue or a scrip issue. They can also call it a scrip issue. Then we also look at what we call the rights issue. Then we move on to diluted earnings per share. Okay, let's look at the issues at a full market price. Okay, let's assume that we are in business and our financial year is 31 December every year. We're in business and our financial year is 31 December every year. The profit that we made for the year, which is attributable to the ordinary shareholders, is 20,000. So the question will say that shares in issue from the beginning, the company has 50,000 shares in issue. 50,000 shares in issue from January. Okay, this is the shares that we have from the January. Okay, assuming there was no additional issue of shares, what will be our basic earnings per share for this year? Assuming there was no additional issue of shares, what would be our basic earnings per share for this year?
0.4.
Okay, how do we get a 0.4?
The earnings divided by the number of ordinary shares.
Okay. Okay. Do you know why we do the earnings divided by the total of the number of shares that we have? Okay. The profit was made for this year, January to December, isn't it?
Yes.
Okay. And this year's also was there from January to what?
December.
So the assumption is that we have used 50,000 shares to generate a profit of what, 20,000. So this is the full share that we use to generate that. So that is if there is no issue of shares. But mostly, the company might decide to undertake a new project where they want to finance the project through what? Equity. So let's still look at that particular example. Our profit for the year.
Linus.
Yes, please.
Yes, please, can you go back? Let me ask a question, I beg.
Okay.
Yes, the 31st December, you see, from the profit is from January to December.
Yes, please.
It's 20,000.
Yeah.
Shares issue is 50,000.
Yeah.
So can we have a situation where the shares in issue, it is from January to August, okay? But the profit is also from January to December. How do you calculate? It was just something that was going through my mind.
No. The shares will be there before you even start you even start doing business. So before you even establish the company, it means that you have already sold the shares to the shareholders.
Okay.
Okay, so even if the company wants to buy back their shares, I don't think they can buy all. But if they want to buy all their shares back, it means that there won't be any equity. If there won't be any equity, what you are going to do is that the profit is for a year and the shares are for only 8 months, isn't it?
Yes.
So what we do is that it means that we have the shares we are used for only 8 months. So come and calculate the 8-month profit of this. 8/12 times 20,000. Then the answer that you get will be the figure divided by the shares that we have. So you calculate the earnings per share for only 8 months.
Okay.
Okay.
Okay. Hey, Hina, terrible.
All right, Genia.
Yes, I want to also know when we say the weighted average number of shares, what does it mean?
The weighted average number of shares is where you have so many shares coming in before the year ends. So you can see that the shares that we have over here is the one at the beginning to the end. But it can happen that during the year, the company issue additional shares. So if the company issue additional shares, we can't use all the shares that the company used to calculate the earnings per share. Okay, let me use this example here. I will explain the weighted average over here from this place. Okay, so the profit is still 20,000. Okay, and the question will always say that a company has an issue, shares in issue to be 50,000. Okay, so they say that on 1st August, the company made a full market. The company issue additional shares. Okay, let me just make it the company issue additional shares. The company issue additional shares. The company issue additional 10,000 shares. Okay. All right. Let's come here. You can see that this 20,000 over here, it was not only 50,000 shares that we are used to generate that 50,000. Can you see that? That it was not only the 50,000. It was not only the 50,000 that was used to generate what? The 20,000. You can see that we have the 50,000, and on 1st August, the company issue additional shares of what? 10,000. Okay. But you can see that from January to July, this 10,000 has no impact on the profit that was made from that period.
Yeah.
Can you see that?
Yes.
Okay. So the impact that these shares we are making will be from August to what?
December.
Okay. So the question is, which number of these shares, out of these 10,000 shares, which number of it was used to generate the profit from August to December? So we find the proportion of this. August to December is how many months?
5 months.
5 months.
Okay. So that will be 5/12 times what? 10,000.
10,000.
Okay. So it means that out of the 10,000, we were able to use it for only 5 months. It generated or it contributed to the profit by only 5 months. So we can only share the profit for that 5 months. So this will be 5/12 times 10,000. What are we getting?
4166.67.
Okay, so let's assume that we are getting 2,000 or something. No, we are not solving any question. It's an assumed figure. So let's assume that we are getting 1,005, isn't it?
Okay.
So we use 1,005 together with what? You can see this was there at the beginning to the end. So the 50,000 contributed from January to July, and the same time August to what? To December. So the 50,000 is going to has contributed to the profit for the full year. So our weighted average number of shares will now be the full year. The 50,000 will be there from January to December, which is 50,000 shares plus the 1,005. which is the weighted. This is what we call the weighted average number of shares.
Okay.
Are you okay, Gina? So I don't know how I'm going to explain to you. So the weighted average number of shares, because I'm a business student, so I don't know how I'm going to put the English to convince you, but let me try. So the weighted average number of shares can be said as the total number of shares that we are used to generate a profit for that particular year. Maybe if I say something like that, maybe you are convinced. The weighted average number of shares is the portion of the shares that will be raised for dividend payments. I don't know how I'm going to say it. The total number of shares that has contributed to the what? To the earnings for this particular year. Gina, are you convinced? Gina, are you convinced? If you're not convinced, then you have to be convinced by force. Okay. So that is a figure. So this is the meaning. I can only use figure to explain the weighted average number of shares. So what is the total number of shares that we are used to generate that particular profit? Okay. You see, some people can also calculate it like this. You see, we have so many ways of calculating the weighted average number of shares, but I like this one. So I will advise you, I will show you the one that you like, then you do it. You can see that from January to July, the shares that were there were only what? 50,000, isn't it? So we can see that the 50,000 has contributed for 7 months first. So that will be 50,000 times 7/12. Okay. From August to December, then the share has now increased. It will now be 60,000 times 5/12. So from January to July, we were using the initial 50,000. But from August to December, we now have 60,000. And this has contributed for only 5 months. So this is how we do it. This is how you can find it. But I will tell you that, let's do this one. Let's do the two. Let's do 5,000, 50,000 times 7/12. What are you getting?
$29,107.
The total.
167.
Okay.
Okay, the total.
Okay.
No. I'm talking of the
okay,
January to July.
167. Okay. This
Yeah.
will give us what? The second one will give us what?
60. That'll give us 25,000.
Okay. 25,000. Okay. If you add it to
54,167.
54,167. So this is the
Yes.
weighted average number of shares. But let me also show you a simple way of calculating this. Okay. We can see that we have 2 shares now. One is 50,000. This 50,000 was from what, January? It was there from January, isn't it?
Yes.
So it means that from January to December, this number of shares will still be there. So you can see that this thing the shares has contributed 1 year to the profit. So this will be used for the calculation. But if you come to the second one, this was there for how many years? So the first one will be January to December. We have the 50,000. This will contribute for 12 months, 12/12, which will still be the 50,000.
Yes.
But if you come to August will be there. From August to December, how many months is that?
5 months.
So this will be 5/12 times what? 10,000. The 10,000 will be used for only 12 months. What are you going to get?
4,167.
If you add the two, what are you getting?
54,167.
Okay. So mostly this will confuse you. This fraction, this prorating is somehow confusing, but me, I'll be using the two. The one that you like, then you pick it. So this is the
I
weighted
want
average.
to ask, how did you get the 1,500? Sorry for sending you back. You did 5/12 times 10,000.
No,
You wrote equal to 1,500.
I said let's assume that we are getting 1,005. So that is not the correct answer. It's just an assumed figure so that I can use it to explain. Are you okay?
Yes, sir. So with the weighted average right now, if you're calculating, it's going to be the profit, which is the 20,000 over the 50 plus the 1,500, right?
No. That is the assumed figure. But if you are using the correct figure, it will now be the 20,000 divided by 54,167. But I was just assuming that, let's assume that 5 over 12 times this is 1,005, so that I can use it to explain whatever I want to explain.
Yes, sir. Thank
Okay.
you, sir.
All right. So this is how we calculate the full market price. You just ask yourself, when was the additional shares issued? So this will be used for how many months to generate the profits. Then we just prorate it using the number of months that it will contribute to the profits. So that is how we do. Let's look at tutorial question. Let's look at example 1 and that. Then we move on to bonus issue. Okay. Let's look at example 1. Seems like my reader is not here. SK, can you read for us? Okay, someone should read for us. Example 1. And that's it.
Example 1.
Yes,
A company makes a bonus issue. Is that that one?
No. A limited.
No, limited.
Limited.
A limited.
Limited.
That one.
Come again. I couldn't hear.
A limited has earnings of 300,000 during the year ended 31 December 2016. On 1st January 2016, A had share capital of 10,000. Immediately after the issue of shares at a full market price. That is still page 1.
Page 1.
Yeah, example 1, page 1.
Okay. Is it A Limited has earnings of
300,000?
Okay, A Limited has earnings of 300,000 during the year ended 31 December 2016. On 1st January 2016, A had share capital of 100,000 of 1 Ghana cedi each. On 1st March 2016, a further 60,000 shares were issued at 3 cedis, 25 pesos per share. Calculate the basic earnings per share.
Okay. So you can see that this is very simple. So the earnings for the year is what, 300,000, isn't it? Okay. At the beginning of the year, the company is having what, 100,000 shares in issue. So these 100,000 shares were the shares that they have. So it will be there from the beginning to the end. But during the year, what happened? On 1st March, 2016, the company issued
60,000 shares were issued.
60,000 shares were what?
Issued.
Okay. So you can see that the year end of the company is what? Their year end is 31 December
2016.
Okay, 2016. Okay. So you can see that the existing shares were the what? The balance brought down. Mostly the balance brought down is the existing shares. So the shares that they're having from the previous year to this year is 100,000. That will be there from the beginning to the end. Because there will not be any issues that a company will be buying back their shares. No. So the 100,000, if no additional shares were issued during the year, the 100,000 will be there from the beginning to the end. So if you want to calculate your WACC, I'll use the 2. We'll calculate it from the 2. So let's use the first approach. So the WACC will be the existing shares. Let's find the existing shares. Existing shares will be there for 12 months. So they will contribute to the profit for 12 months. So that will be 10,000 or 100,000 times 12 over 12. And that will give us the 10,000 again. 100,000 rather. Let's talk about the new shares now. The new shares were issued from which date?
1st March.
So 1st March to December. 1st March to December is how many months?
That's 10 months.
9 months.
They are,
9 months.
no, it's first March. Oh.
My first March, so it's 10 months.
10 months.
Okay.
Yeah.
So the 6,000 is going to contribute to the profit from March to what? December. So which is what? Only 10 months. So that will be 10 over 12 times the 60,000. What are we getting?
Fif-
50,000.
50,000.
That will be 50,000. So our total weighted average is 150,000.
50,000.
100.
Let's look at the second approach. Okay. The second approach is existing shares. Let's take the existing shares. Existing shares. Okay. What will happen? Before the new shares were issued, the existing shares have been there for how many months?
Sure.
No, before the
3.
new shares were issued,
Oh.
the existing shares have been there for how many months?
2.
They have contributed for only 2 months. So that will be 100,000 times 2 over what? 12. What are we going to get?
That will be 17,000.
Are you approximating it?
16,667 actually.
Okay.
66.
6, 6, 6, 7, isn't it?
Yes.
Okay. So
Yeah.
from March to what? So the first 2 months, the profit generated was for only the existing shares. So from March to December now, the shares that will be used to generate that profit will be the existing one plus the new one. Are we okay with that?
Yes.
Yeah.
Times what? 10 over what? 12.
Oh.
What are we getting?
One, three, three.
1, 3,
3,
3.
3.
1, 3,
3,
3, 3, 3. And that will give us 150,000 at the end.
Is it 60,000 or 160?
It's 160. We have done 2 months.
No, please switch question.
Example 1. Under the page 1. Still on page 1, example 1. Okay, so what we did is that before the new shares were issued, the first 2 months profit was generated by the existing shares. So we find a portion of the shares that was used to generate that. That will be the 100,000 times 2 over 12. After the new shares were issued, the 10 months, we are still going to be using the 100,000 shares plus the 60,000 shares. These are the 2 shares that is going to generate the last 10 months profit. So how do we do it? We find 160,000 times 10 over 12 so that you can add the 2. But this one is sometimes confusing. This particular one is sometimes confusing. So what I advise mostly is that since mostly the existing shares will be there for what? 1 year, full year. So you just have to come and prorate the new shares. The existing shares were there at the beginning up to the end. So that will be used for the full 12 months. So nothing is going to happen to them. But it is the new shares that will not be there for 12 months. So how do we do? You have to try to prorate the existing one. So our basic earnings per share will be our earnings of 300,000 divided by 150,000 shares. How much are we getting?
It's 2.
It's 2 Ghana cedis per share. Okay. What we have to know is that earnings per share is always calculated in the lower denomination of the currency. So if the answer should have been 0.5, what we do is that we multiply it by 100 to get 50 pesos. So don't do 0 points. Whenever you are having 0 points, it is not a full Ghana cedi. Multiply to make it what? Pesos. So the earnings per share is always calculated in the lower denomination of the currency. So if you're having 0.1, make it 10 pesos. Don't make it 0.1. All right. So that is about the full market share.
If you're having 1.6, it will be 1 cedi 60 pesos.
No, just make it 1.6 Ghana cedis.
Okay,
The
so
only-
Lalo, so what
Yes.
happens to the 3.25 that they have issued?
The three words. No, that is the market,
Yeah.
that is the market value.
Okay. So you will not consider it.
No. We are only interested in the number of shares. The only thing that they will do is that they will multiply the 60,000 by 3.25 and add it to their equity. We are only interested in the shares. We are looking for the shares, not the value.
Okay.
All right. Let's look
So,
at
Lani, it means that if you are looking for the value, that is why you have to multiply by the
yes,
percent.
yeah, to know the total value of the shares that we'll be having. So the total
Okay.
value of the shares, if you should know the value, it will be 100,000 because the 100,000 is at 1 cedi. Then
Yes.
60,000 multiplied by 3.25. But you can see that they have issued the shares at a premium of 2.25. Yeah, I don't want to go there, but let me say something like this. You can see that their equity shares is valued at 1 cedi, isn't it? Okay, so anything that you send to the share capital account or the equity share capital account should be at 1 cedi. So the first one, we are going to have the existing shares. We are going to have the existing shares to be 100,000, which will be 100,000 times 1. So that will be 100,000, which is the balance brought down on the stated capital. Then we have new issue. The new issue will also be 60,000 times 1, which will be 60,000. Then we have 160,000. Then the company will now have what we call a share premium account because the actual value of the shares is what? 1 cedi. But we are issuing at what? 3.25. So the shares were issued at a premium of 2.25 times 60,000. Then that value will be put in the share premium account. So if the value of the shares is 2 cedi and you are issuing the shares at 4 cedi, we don't take all the 4 cedi amount there. The only value of the shares that you can take over there is 2 cedi per share. So the remaining 2 cedi will be sent to share premium account. But this one is not needed as far as we are doing any per share. We are only interested in the number of shares. We are only interested in the number of shares. Let's look at another issue under the basic earnings per share. The things that is going to affect the basic earnings per share will be additional share of issues or additional issue of shares during the year, or the company has made what we call a script issue or a bonus issue. The company has decided to make what we call a script issue or a bonus issue. The company can also decide to pay a dividend with shares. The company can decide to pay a dividend with shares. If the dividend that you are going to pay, it is at the end of the year, the share is not going to have any effect on the weighted average number of shares. But if the dividend that you are going to pay is a dividend that is due in 2 years' time, now you are coming to pay with shares. We assume that you have already paid the dividend with the shares in the 2 years' time. Okay, but the question will not be about scrip dividend. You using shares to pay dividend instead of cash is called scrip dividends. It's called scrip dividends. Okay, you using dividend to pay, you using shares to pay for dividend instead of cash is what we call scrip dividend. But the question will not test you on this. Okay, the question will not test you on this. So let's come to bonus issue. What do we call bonus issue or scrip issue? What do we call a bonus issue? bonus issue. Auntie Gina, bonus issue.
Hey,
Yes, please.
this is where the company issue additional shares to existing shareholders without taking any cash. So usually they issue these shares from the retained earnings of the company.
Okay, 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 okay. Auntie Gina, you say you don't know. Now you know. Okay. Now you have to know. So that is what we call a bonus issue. A bonus issue means you changing your reserves to shares. So you can see that your reserves are plenty, and you're now saying that, okay, let's convert some of our retained earnings to what? To additional shares. So that is what we call a bonus issue. It doesn't come with any money. So the reserves are there, but we want to make use of the reserves. So what we do is that we change the reserve to shares. We change the reserves to shares. So that is what we call a bonus issue. The reserves were there from the beginning to the end. The reserves have been with the company forever. So whenever there is a bonus issue, we assume that the bonus issue has been in existence from the time that what the company started. Whenever there is a bonus issue, we assume that the bonus issue has been done a long time, but just that the company did not declare it. But now they have declared their intention. So the bonus issue, in basic terms, is not time apportioned. Bonus issue is not time apportioned, or bonus issue for the first time without anything is not time apportioned. I'm very careful with how I'm saying it. Bonus issue made for the first time is not time apportioned. Or bonus issue made before a full market issue is not time apportioned. So if you have a shares of 100,000 and you have made a bonus issue of 144, you didn't make any full market issue before the bonus issue. We don't do anything. We don't time apportion the bonus issue. We assume that the bonus issue has been in issue since. So bonus issue, even if the bonus issue was done on the last day of the year, 31st December 2021, we are still assume that the bonus issue has been there from the beginning to the end of the year, because we are making this from the reserves, and the reserves has been there from the beginning to the end of the year. So the bonus issue is very simple. Bonus issue is very simple. Whether it is done at the end of the year, 2 months to the end of the year, we assume that it has been in issue since. We don't say that it has been issued 2 months to the end of the year, so we only find 2 months of it. No, bonus issue is not done like that. Even if it is 3 days to the end of the year, we assume that the bonus issue has been there from the beginning of the year. All right, so let's take this one. Sometimes we see what we call something bonus fraction and those ones. I will show you how we calculate the bonus fraction and all those issues. Let's take the example one.
Linus,
Yes, please.
please can you explain the one for 4 before we put the question? Yes.
Hey, I'll explain these things. Hey, Razak. Okay.
Yes.
144 is that. 144 is that. You see, the new shares that we are going to make now, we are going to give you one new shares for every 4 of the existing shares that you are having. So if you're having 100,000 shares, it means that for every 4 of these 100,000 shares, we are going to give you 1 share. So for every 4 of this, or bring 4 of the 100,000, bring every 4 of the 100,000 and take 1 new. So 1 new for every 4 existing shares. That is the meaning. So if you want to calculate it, it is always the number of shares that you have divided by the number of existing shares that you are going to take there. So how many of the existing shares will you take there? How many 4s of the existing shares will you take there? That will be 100,000 divided by 4 times 1. Mostly, it is calculated as 1/4 times the existing shares.
Okay.
1 over
Minus
that
20.
times the existing shares. All right.
Okay.
All
Minus
right.
25,000.
Okay. So that will give you what? 25,000.
1,000, yeah.
So your total number of shares will now be what? 125,000. Okay.
Okay. Okay. All right.
Okay. This
Thank you.
125,000 can also be calculated like this. This 125,000 can also be calculated like this. You can see that what we calculated was 100,000 plus 1 over 4 times what? 100,000, isn't it?
Yeah.
Is that the case? Okay. That is the case. Okay. We can also say that, okay, I want to show you how we mostly use the bonus fraction. We mostly use the bonus fraction. So this is calculated like this. Assuming the bonus fraction is 1, it will be 1 plus 1 over 4 times 1, which will be 1 plus 1 over 4, which will be equal to 4 plus 1 over 4, which will give you 5 over 4. So mostly they will be using the bonus fraction mostly. I will show you when we should use the bonus fraction. How do we calculate the bonus fraction? The bonus fraction is calculated as, let's take this question. Let's take the example one, then I'll show you how we calculate the bonus fraction.
Okay. Example 1.
Okay.
A company makes a bonus issue of 1 new share for every 5 existing shares held on 1st July 2016. Relevant information. Profit attributable to equity shareholders for the year ended 31st December 2016, 550,000. 2015, 460,000. Number of equity shares in issue at 31st December 2016, 1.2 million. 2015, 1 million. Calculate the basic earnings per share for 2016 with comparative. That is where it ended. I think there should be a continuation.
Oh, that is all with comparative. Okay.
Okay.
So let's come here. When was the bonus issue made?
Um,
1st July 2016.
Okay. The bonus issue will always be made on the existing shares. So the bonus issue will be made on the 1 million. The 1 million will be the opening shares for what? For 2016. So if you do 1 over 5, the bonus issue is what? Bonus issue will be what? 1 over 5 times the what? Shares at the beginning, which is 1 million. What are you getting? So it is 1 for every 5. So 1 over 5 times the 1 million. What are you getting? Would that be 200,000?
Oh, yes. 1 over 5 with 200,000.
So you can see that the 2016 is 1,200,000, isn't it? The 2016. So it means that they have already added the bonus issue to it. They have already added the bonus issue to it. So you take note of that. The bonus issue will always be made on the shares at the beginning, existing shares. Okay. So the question now is, let's assume that the bonus issue was not done. What would be the basic earnings per share for? Yeah. Someone want to call me? Or the person is off?
From the previous year, right?
Is that? Okay, the person is off. Okay, so the bonus issue will always be done on the shares at the beginning. Okay, bonus issue for the first time will always be done on the existing shares. And the existing shares will be the 1 million, which will be the opening shares for what? For 2016. So the shares given to you over there are shares at the end. So you can see the number of shares in issue at 31 December. So the 1,200,000 is the total number of shares for 2016, which they have already added a bonus issue to the 1 million. Okay, let's come to 2016. The question is saying that we should calculate the basic earnings per share for 2016. So what is the profit for 2016? Would that be 550,000?
Yes.
Divided by 1,200,000 shares, isn't it?
Yes.
We don't prorata the weighted average number of shares. We don't prorata the weighted average number of shares will be the existing shares. The existing shares of 1 million will be there from the beginning to the end. And the bonus issue, whenever it is made, we assume that it has been in issue since. So the bonus issue will still be 200,000. So this will be our weighted average. We don't prorata. Don't say that the bonus issue was made in July, so it will be 6/12. No, bonus issue was made out of what? Out of the reserves. So since it is not bringing any money, it means that it has been there since, but we just decided to make it known to the public now. Okay, so that would be 200,000. Okay, so what will be our basic earnings per share? Zero point
0.46.
No, I'll say something first.
Now you say you will multiply by 1, will multiply by 10 or 100.
100.
So to get the absolute figure.
Okay.
What is this?
Okay, you can make it 46 pesos or 45.83 pesos, isn't it?
Yeah, 4.6 pesos. 4.6 pesos.
Okay, let's count to 2015. They say that we should do comparative. Comparative means this year together with the previous year. Assuming that the bonus issue was not done. The bonus issue was not done. What will be the basic earnings for 2015? It will be 460,000 divided by what? 1 million, isn't it? And that will give us 46 what? Pesos. Okay. Assuming the bonus issue was not done, this is what we are going to get. This is what we are going to get. But the issue, what we are saying is that whenever a bonus issue is made, we assume that the bonus issue has been in the bonus issue has been there since. The bonus issue has been there since. So even if the bonus issue has been done in 2015, we assume that it has been there from 1993, the time that the company has started. We assume the bonus issue has been there from the time that the company has started. Even if the bonus issue is done 2022, we assume that it has been there 2019. So the bonus issue is going to have a retrospective effect on the earnings per share. So even though the bonus issue was made in 2016, we are going to assume that the bonus issue has been in 2015 too. If we have 2014, the bonus issue will affect the 2014 too. We assume that the bonus issue has been there since. So what will happen is that if we should take into consideration the bonus issue, what will happen? If we should take into consideration the bonus issue, our basic earnings per share for 2015 will be 460,000 divided by 1,200,000, because this will be the shares plus the bonus issue. So what are we going to get? What are we getting? I'm getting 38.3 pesos. Is that correct?
Yes, please.
Okay. You see, mostly the question will not give you this figure. The question will not give you how you calculate. The question can only give you the earnings per share for 2015, which they will ask you to what? To show the comparative. What we do is this. Let's come here. Let's come here. You can see that the bonus, the total shares The total shares is now what? The total shares after the bonus issue is now 1,200,000, isn't it? Okay. The bonus issue fraction is what? 1/5. Am I correct? The bonus
Yes.
issue fraction is 1/5. Okay. When we calculate the bonus issue, what do we do to get a total number of shares? We now add it to the existing shares, isn't it?
Yes.
So if the bonus issue, if the existing shares is 1, if the existing share is 1, it will be 1/5 times 1, which is the existing share. That will give you the bonus issue. Then we now add this one to the existing share, which is 1. So this will now give us 1/5 plus 1. Let's find LCM. The LCM will be 5. 5 will go to 5. 1 times 1, and 1 will go to 5. So 1 times 5 is 5. This will give us 6/5. So the bonus issue fraction, the bonus issue fraction is 6/5. How do we get a 65? Let me just show you a simple way of getting the 6/5. What you do is that just add 1 to the bonus issue. The bonus issue fraction, the proportion that you are given. If it's 1/4, that is 1/4 plus 5 plus 1. That will give you the bonus issue fraction. So if you want to get a total shares after the bonus issue, what you do is that it's 6/5 times the 1 million. So if you want to get a total shares, it is the bonus issue fraction multiplied by the existing shares. What are you going to get over here? Would that be 1,200,000 shares? Would that be 1,200,000 shares?
Yes, please.
Yes. So you can find this one straightforward. You can find this figure. What I've gotten over here, the bonus issue 200,000 plus the existing one. You can do that directly by applying the bonus fraction on the existing shares. Straightforward. Okay. And this one that we have calculated over here, the 2015 that we are assuming that the bonus issue has been there since, we can also calculate this by using this one. So we can calculate the comparative by this 2015. Then the comparative, the basic earnings per share will now be the reciprocal of the bonus issue fraction. The reciprocal means that the numerator will become a denominator, and the denominator will become the numerator. So we now have 5/6 times 46 pesos. What are you getting? If you multiply, what are you getting? You get something like 38.3 pesos. Is that correct?
Yes, it is.
Okay. So what I want to say is that mostly they will not give you something like this. You see, this one, they have given you information for 2015. So what you do is that you assume that the bonus issue has been there in 2015 too. So you now calculate the earnings per share for this one, taking into consideration the bonus issue. But mostly they will not give you that figure. They will not give you the shares for last year. They'll only give you the earnings per share for that particular year. And they'll ask you to calculate the comparative. We use the bonus issue fraction to do that. So let me use the example 2 to now demonstrate that. Then we go to what we call a bonus issue and issue at a full market price combined. Okay. Let's look at example 2.
I have a question. So supposing there are bonus fractions that they have given, it's 2 for, let's say 2 for 4.
2 for 4. 2 for 4. Okay.
And then you are asked to find the bonus fraction. Can you say that the bonus fraction is 6/4?
Let me, I don't know. You are saying, can you see? Let me check. Okay.
Yes, because if you do your calculation, you take and then.
Okay. So this is same as 1/2 plus 1. Okay, that will be 3/2, which is same as 6/4. Okay. That is a bonus fraction.
Yeah, okay. So that's what I want to get.
Yeah,
If I can just work it like that.
Okay. You can work it like that, madam. Thank you. All right. But just go by what works for you. You see, I'm not going to post anything on you, but I'm just trying to make it understandable to you so that whatever you want to do there, you have the freedom to do it. Whatever you want to write in the paper, you have the freedom because you are not going to see what you have written. It is left with the
Yes, but
examiner.
I see, you see the 2015, you have turned it down, like the bonus fractions, you have made it 5/6 by
Yes,
this.
we want to find the actual figure. If the bonus issue should be, the figure given to you is without a bonus issue. So we want to find it, taking into consideration the bonus issue. So we turn it upside down to find the earnings per share for the previous year. That is for only the previous year, not the current year. Okay, let's look at
so,
example 2. Yeah.
So maybe it's also a way of checking yourself whether what you did is correct.
No, mostly they will not give you the, you see the question that we have solved, you can see that you are giving the earnings for 2015 and the shares for 2015. The question always will not give you that. They will just give you the earnings per share for that particular year.
Okay.
Yeah. Then you have to use the bonus fraction to do that. Let's take the question, example 2. Then we move on to additional 2. Then we look at diluted. Diluted is, there's no important issues there. Then we solve maybe at least 2 or 3 questions. Then we close. All right.
Okay. At 1st April 2015, D Limited has 7 million 1 cedi ordinary shares in issue. It made a bonus issue of 1 share for every 7 held on 31st August 2015. Its earnings for the year were 1,150,000.
Okay.
D Limited's earning per share for the year ended 31st March 2015 was 10 cedis, 70 Ghana pesos.
Okay.
Required. Calculate the earnings per share for the year ended 31st March 2016, together with the comparative earnings per share for 2015 that would be presented in the 2016 account.
Okay. So what is the earnings for this year?
$1 million.
Okay. So what is the existing shares that they have before the bonus issue? It is what?
7 million.
It is 7 million shares. So check that one.
Million.
Okay. So regardless of when the bonus issue was made, we assume that it has been made from there. It has been with the company since. So let's find the bonus issue. What will be the bonus issue fraction? I'm interested in the fraction. Would that be 1/7 plus 1? Would that be 1/7 plus 1?
Yes.
It is 1 for every 7.
1/7.
1/7.
Okay. We want to get the bonus issue fraction, though we add 1 to it. So that will be 1/7 plus 1. That will give us 8 over what?
7.
7. So if you want to find the total number of shares after the bonus issue, total shares after the bonus issue is the same as 8/7 times the existing share, which is 7 million. What are you getting? 8 million shares. Is that correct? Is that correct? Is the 8 million correct?
Yes.
Okay. Someone can also find this 8 million like this. The person can first decide to find the bonus issue. The person can first decide to find the bonus issue. So the person will find the bonus issue first like this. Bonus issue. The person will find the bonus issue to be 1/7 times the 7 million. And the person will get 1 million. Then after that, then the person will now add the 1 million to the 7 million. So they have 7 million already, but they are issuing additional 1 million through a bonus issue. That will give you 8 million. The same thing. The same thing. Okay. So let's now find our earnings per share for the current year.
Yeah.
Yes, please.
Quickly, I had to attend to some emergency. Can you quickly explain how the fraction is calculated.
The fraction is you take the bonus proportion. How are they making it? This is 1/7. It is 1/7. So 1/7, that is the bonus. That is a bonus proportion. Then you now add 1 to it.
Okay.
Then you put it in the calculator. The calculator will give you the answer. Then you use that answer to multiply the existing shares. That will give you the total shares after the bonus issue.
Okay.
All right.
Thank you.
All right. You're welcome. Okay. So let's move on. So let's calculate the earnings per share for the current year, which is that will be 2016. Okay. 2016. So the basic earnings per share will be equal to, what is their earnings? What is the earnings for this year? 115,000 divided by 8 million, isn't it?
Yes, please.
Okay, 8 million shares. So what are you going
So
to
you
get?
get 14. You get 14.
14 pesos. 14 pesos.
Yes.
Okay. So that will give us 14 pesos. Okay. Per share. Don't forget to add a per share to it. 14 pesos per share. So they are asking you to find the what? The comparative. Is that not the case? Okay. So the comparative will be for 2015. So it means that we assume that the bonus issue has been in 2015 to not only 2016, because whenever there is a bonus issue, we assume that it has been in issue since. So what we do now is that our bonus issue fraction is 8/7. So we turn it upside down. We have 7/8 times the basic earnings per share for the 2015. That will be 10.7 pesos. What are you going to get? So 7/8 times 10.7. I'm getting 9.36. Is that correct?
Yes, it's correct.
Okay. We can also find this like this. Okay. We can also find a comparative like this. Okay, 2015. The basic earnings per share. The earnings per share for 2015 is how much? The basic earnings per share is what? Is 10 point what? 7. And the shares that we use in that year, the number of shares that is used to calculate this was 7 million. Am I correct? Okay, this was calculated without taking into consideration the bonus issue. It means that we use the 7 million to calculate the earnings per share in 2015. So what will be our total earnings for this year, for the 2015? What will be our total earnings then? Our total earnings will be the 10.7 times 7 million. Are we correct with that? Would that be correct?
Yes, sir.
Okay, how much are we getting there? 10.7 times 7. I'm getting 74.
74.9.
Okay, so this is the earnings. Okay, so let's now calculate our basic earnings per share, taking into consideration the bonus issue. It will be the earnings 74.9 divided by what? 8 million.
What is it?
Divided by,
9.936.
that will give you 9 point what?
36.
Okay, that's all. So you can calculate it like that too. You can calculate it like that by working it backwards. So our basic earnings per share will give us 9.36 pesos, which is the same as this. But mostly they will not give you information to do this. They will only give you the earnings per share for the previous year. So you have to use a bonus issue fraction to calculate the comparative. So this is how you are going to show it. You show your basic earnings per share like this. Then you put 2016 here. then you put 2015 here. So 2016, it was 14 pesos, and the comparative, it was 9.36. All right, let's look at bonus issue and issue at a full market price combined. Issue at a full market price combined. So what normally happens is that, let's look at this. What normally happens is that the company has the existing shares that the company is having now. The existing shares that the company is having now is 10,000. Okay. On 1st March, on 1st March 2021, the company made a full issue at a full market price of 5,000. Okay. And on July 31, or let me make it 1st August. Okay. Okay. On 1st August, the company has made a bonus issue of 144. Okay. The issue now is, how do we go about this? How do we go about this? How do we go about this? Okay. What you can see over here is that you can see the company has existing shares of 100,000, and on 1st March they made a full market issue of what? 5,000. But on 1st August, the company has made a bonus issue of what? Of 144. Let's look at this. You can see that the bonus issue is going to affect two shares over here. Can you see that the bonus issue is going to affect two categories of shares here? The bonus issue is going to affect two categories of shares here. Can you see that? Can someone see that?
Yes, please.
Okay, you can see the bonus issue is going to affect what? The first what? 100,000. And the bonus issue will also affect what? The 5,000, because the 5,000 was there before the bonus issue was made. So the bonus issue will be made on the shares that were existing before the bonus issue. So the January to December, the bonus issue will affect this one. But the bonus issue will affect this one from March to what? To December. So how do we go about this? If you want to find your WACC, this is how you find your WACC. This is how you find your WACC. Okay, I will show you the percentage one. Okay, for the bonus issue, I haven't shown you the percentage one. Oh, sorry. Okay, but this one is simple than the percentage one. Okay, the fraction one. What will happen is that the existing shares, since they have been there from January to December, the bonus issue will affect them what? Fully. So what is the bonus issue? The bonus issue is what? 144. So the total shares will be what? It will be 100,000. The existing shares over 1/4 times 100,000. What are we going to get for the existing shares? What will be their value? So what will be the share value for the existing shares?
$125.
Okay, that will be 125,000. So it means that, okay, so it means that we already have 100,000 and we are making a bonus issue of 144 on that. So the total number of shares at the beginning will now be 125,000, because we assume that the bonus issue has been there since. So since the 100,000 shares has been there at the beginning, the bonus issue is going to affect that. That's how we do. But if you count to 1st March.
Linus.
Yes, please.
I beg.
Yeah.
What if you just use this simple method, the 1/5, where you just make it 5/4 times the 100,000. I realize that you get the 125 straight away.
Yeah, using the bonus fraction, isn't it?
Yes.
Yeah, you don't have any problem with that.
Okay, all right, thank you.
But let's count to March. The March. the March. What will be the bonus issue on the March shares? It will be 5/4 times what? 5,000, isn't it? The bonus issue will be made on the 5,000. What are we going to get there?
That'll be 6,000.
That will be 6,000. Okay. So you can see the total number of shares now is what? 6,000. But this shares has been with the company for how many months?
For 9 months.
It is first March. Oh.
No, for 10 months.
For 10 months. So we do 10/12. What are we getting?
You get 5,000.
5,000. Okay. So our weighted average will now be 130,000. That is it. Okay. This is how we find the bonus issue. When there is a market issue plus the bonus issue. The market issue, the bonus issue will affect it, but the bonus issue will affect it from the time that the market issue was done. So the bonus issue will be made on the 5,000, although, but it will not be a full year because these shares start existing from 1st March. So the bonus issue will take effect from what? 1st March. It will not take effect from January to December because the 5,000 was not at the beginning of what? The year. So the bonus issue will take effect from the time that the full market price were issued or the full shares were issued. So this is how we do it. The bonus issue will have a full effect, a full year effect on the existing shares. But the full market shares, the bonus issue will have effect from the time that the shares were issued. So
Please, how do you get the 6,000?
The 6,000.
the 6,000, we have 5,000. The full
Correct.
market was 5,000. And the bonus
Yeah.
issue was what? 144. 144 was made on what? 1st August. So it means that we have issued these shares before the bonus issue was made. So the bonus issue will affect this one also, the 5,000 also.
But if you use the fraction, you will not get the 6,000.
Linus, please, I mean, it's supposed to be 6,250.
6,250.
Yeah, 250, yes.
Okay, so 6,250. Sorry. Okay. So what are we going to get over here? This will not be 5,000.
Yeah. So 62.
Are you sure? 6 to
It's
So 5,208.
5208.
okay.
5,208.
43.
5208. Okay. So if we
Yeah.
add this one, then it will be 208 here. Okay. So this is how we
So
find the
208.
okay. So this is how we find this is how we go about the bonus issue and then the full market value and then the bonus issue. The bonus issue will have effect on the existing shares. If the shares is there at the beginning, it means that the bonus issue will have effect from the beginning. We assume the bonus issue was done at the beginning. But if the shares start existing from March, it means that the bonus issue will also have effect from March. So although the bonus issue will be on the 2 shares, this one is full year. So the bonus issue is assumed to be done at the beginning of the year. This one is starting from March. The bonus issue will be done from what? March. So this is how we go about. Let me show you the fraction 1, 2. Let me show you the fraction 1, 2. The fraction was somehow complicated, but let's try. Okay. So what we do, the bonus issue, okay, you can see that, let's look at this. The existing shares were there for how many months before the full market issue? They were there for only 2 months, isn't it? So we have 10,000, 100,000, then we multiply by the bonus fraction, which is 5/4. Then we multiply by the number of 12, the number of months that they have done. So that will be, the bonus issue will have effect on this, then times the number of months that they have done before this one. Then if you come here, your March issue will be down from March to July because the bonus issue was made on 1st August. So this will now be 105,000, the existing shares plus the new shares, times the bonus issue again, 5/4, times from March to July. How many months is that? From March to July.
March.
5 months.
March,
That's 5
April,
months.
May, June, July. Okay.
Oh.
Times 5 months. Okay. Then if you come to August to December. August to December is how many months?
5 months.
5 months.
That will be 5 months. Okay. But from August, what will be the total number of shares that a company will be having? What will be the total number of shares? 125,000 plus 6250. The company will be having 131,250 times 5/12. Do you know how I got the 131,250?
No.
Okay.
Oh, line.
Okay. 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 From August, what will happen is that from August, the bonus issue will be like this. Let's come here. You see that the bonus issue for this one will be 125,000. Is that correct? For the existing shares. Okay. For the 5,000, it will be 6250.
Yeah.
So it means that when we are making a bonus issue, the bonus issue will now increase the 100,000 to 125,000. And the bonus issue will also increase what? The 5,000 to 6250. Then you add it and you multiply by the number of months. This is so complicated, my brother. This is so complicated. But if you do it well, you'll be getting your 130,208. Let's try that and see. So the first one I'm getting 2833. Okay. Let's come to 5,000 times 5/4 times 5 divided by 12. I'm getting 54687.5. Let's come to the last one. 131,250 times 5 divided by 12. So let's add O and C. This one I'm also getting the same figure plus 546,546. It's 7. What are we getting? If you add all, you'll be getting 130,208, isn't it? Someone should confirm that for us. But this is so complicated, so forget about it.
But with Linus, please, so with this formula or this method, are we assuming?
No, we are not
Because
assuming. We are not assuming
so
anything.
where do you get the August to December from?
No, you see, the existing shares will be there for 2 months, which is January to what? To February.
Okay.
Then the right issue will affect it because the right issue will be done on it. Then we multiply by the right issue fraction. Then this has done only 2 months. Then from 1st March, we have made additional issue of shares, which is 5,000. So from 1st March, the 100,000 will be there. The 5,000 will come in addition. But this will be used up to 1st August. Then we make the bonus issue. So the bonus issue affects all of them too. Then the bonus issue will be on this and this because the bonus issue will be for the beginning to the time that the bonus issue was made. So from March, existing shares plus the new shares that we have, then bonus issue will affect it times 5/4 times this will be used from March to August. That will be 5 months, so 5/12. Then we come to the August. After the August, then we make the bonus issue. So what will be the total value of the shares now? It will be the 100,000 plus this. Then we apply the bonus issue on the 2. Then that will also be used for what? August to December. And this is complicated, very complicated. Very, very complicated. So just go back.
But let me explain it right now. I get it. So it's like you have to get the dates, the months right.
Yes, you do it
With
one
this
by
one,
one.
to get them. Come again?
You do it one by one.
Yes, but yeah, you know, at times this first March and 31st March worries.
Okay, okay. But I will advise you to use this. The first one that I've done, you can see that it's very simple. Yes, this one, Philip will say that this is very simple. Okay, this one is very simple. You have to know that the shares, existing shares, the bonus issue will be done on them from the beginning to the end. But the shares from March, since they started existing from March, it means that the bonus issue will be on them from only March. So what is the bonus issue from March to that particular period? And from March to December, these shares will be used for how many months? Then you try to prorate it. That is all. Let's pick a question there. Let's pick a question on this. Example 1. Let's look at example 1 there.
Is it an entity had 1 million shares?
Yeah.
An entity had 1 million shares in issue on 1st January 2014. They issued 200,000 shares at market value on 1st April, followed by a 145 bonus issue on 1st August, with a further 300,000 issued at market value on 1st October. If profit for the year ended 31st December 2014 is 220,000, what is the basic earnings per share?
Okay. This one guy is even, you can see that this one guy, they made a bonus issue before. Okay, they made the full market issue before the bonus issue. Okay. Let's look at this question. So what is the existing shares? What is the opening balance of the shares that they have?
That's 1 million.
Okay. So that will be 1 million. Then, so on which date was the full market share made? Full market issue made? They issued 200,000 shares at a market value on what? 1st April. So April 1, the company issued what? 200,000 what? Shares. And this is followed by what? This is followed by a 145 bonus issue. So August 1, there was a bonus issue. Which is 1 for what? 145. Okay. With a further what? 300,000 issue at a market value. So on October 1, there was a market value issue of 300,000 shares. Okay. So the question now is, what would be our basic earnings per share? Even if you don't know what to calculate, write the formula there. Maybe they can give you 1 mark for that, or 1 mark for that. Earnings over the weighted average number of shares. So the problem is about how to calculate the weighted average number of shares. Okay, let's pay attention to this. When was the bonus issue made?
The bonus was issued in August.
Okay, so it means that the bonus issue is going to affect the existing shares and the shares issue on 1st April, isn't it?
Okay.
So let's come to the existing shares now. What would be the bonus issue fraction?
5. 6 over 5.
Okay.
Over 5.
So that would be 6 over 5 times the existing shares. The existing shares is 1 million.
1 million, yeah.
So that will give us how much? What will be the total value of the shares?
That's 120.
Okay.
1.2.
Okay.
Mm.
Okay. Let's come to April.
1.2, yeah.
April to December, isn't it? Okay. April to December, you can see that we issued 200,000 shares before we made a bonus issue. So the bonus issue is going to have effect on what? On the 200,000, because the 200,000 was there before the bonus issue was made. So the bonus issue will be made on, bonus issue is made on all the existing shares. So all the shares that were existing before the bonus issue is made will be affected by the bonus issue. So the 100,000 will be affected by the bonus issue, which will be there for a full year, because that was the shares at the beginning of the year. It will be there for a full year. But if you come to the second one, it is starting from 1st April, but it was there before the bonus issue. So what will be the value there? It will be 6 over 5 times the 200,000, which will give the total shares plus the bonus issue, the 200,000 plus the bonus issue. So what are we getting there? 6 over 5 times 200,000.
But let me split here. Do you also consider the month?
Yeah, I'll do that. I'm coming. I'm not going to write a phone answer. Okay.
Okay.
All right. It seems like you are active. Okay. Okay. It will not be a full year because these shares were issued on 1st April. So it will be April to
Exactly.
December. Consider I've written April to December there.
Yes,
Okay.
that's
And I want
40.
Okay. So let's just multiply by 9 over 1.
240.
Okay. So these shares will be there for what? Only 9 months. So 9 over 12.
9, yes.
Okay. What are you getting? Hey, people are active. It means that you are very active. Okay.
180,000.
100 and what?
108.
180,000.
Okay. Let's come to what? To the bonus issue will not have anything. Bonus issue, we don't take the date into consideration. We assume that it has been issued from the beginning. So the bonus issue, don't consider the August. We don't take into consideration the date that the bonus issue was made. Okay. But the next one will be October to what? October to December. And the shares there was what? 300,000 times how many months? October, November, December, 3 months.
That's 3 months.
Okay.
3 months.
So that will give us how much?
$75,000.
Okay. So our total number of shares will now be what? Let's add.
$155,000.
1,455,000. Okay.
Yes.
Can we use the fraction and then the month one to confirm this figure? Okay, let's find the basic earnings per share first. So that will give us the profit for the year is what? 220,000.
220,000.
Okay, divided by 1,455,000. What are we getting?
$15.
Whose children are disturbing like that?
Line is 15. It's my children, no?
They don't know what if they should know what is coming after, then they should have gotten a poly tank and put it there. All right.
15 pesos.
Okay, that would be 15%. I hope right now you are okay with this one. This is the simplest way to go about it. If there was a bonus issue, whenever the bonus issue was paid, we assume that the bonus issue has been the issue since. So since we have 1 million at the beginning, the bonus issue, we assume that it has been issued at the beginning. So the bonus issue will be applied on the 1 million, which will be 120,000. And this 120,000 will be from the beginning to the end of the year. That is full year contribution to the profits. April, there was a market issue April. So when a bonus issue was made after the April, we assume that a bonus issue has taken place on these shares from the time that they were issued, 1st April. So we calculate the bonus issue on it. The figure that you get over there from April to December, that will be contributing only 9 months, 9/12. Then the remaining one was 300,000 after the bonus issue. So there are not going to be any bonus issue effect on it. And that will be used for 3 months. That is very simple. Very, very simple. Okay. But if you want us to try the other one, which is this one, no problem. We will get the same answer at the end. All right. Okay. Let's talk about what we call right issue. Then we move on to the okay. Let's talk about, I hope we don't have any issue with this one, this solution. I hope you're okay. All right. Okay, let's talk about right issue. Right issue. What do we call a right issue? Right issue. Or people, right issue.
Yes.
Yes, please.
Please, right issue is a share issue to shareholders below the market price. So
Okay.
usually it has a bonus factor in it.
Okay. That's nice. That's nice. Okay. So the bonus issue basically, bonus issue is issue made to the existing shareholders in proportion of their ownership. Mostly this is issue at a discount. This is issue at a discount. So you can see that the current market price of the shares is 2.5 Ghana cedis, but we are giving to these people at 2.0. It means that we are issuing this at a discount of 0.5. This 0.5 is an assumption that we are making a bonus issue. Part of it is for full market value, and part of it is for what? A bonus issue. How do we go about that? How do we go about that? Or how do we determine the bonus issue part and also the full market value part? It's very simple. We use what we call the theoretical X right price. What do we mean by the theoretical X right price? This is what we call the theoretical X right price. Very simple. Theoretical right X right price. Okay, so those who have done financial management before, you know what we are talking about. All right. The right issue will also be done like the bonus issue, which is 1 for something. It will be 1 for something or 2 for something. That's how it will be done. All right. So let's come here. Let's come here. Let's assume that the company is having existing shares. The company is having existing shares of what? Of 20,000 at 2 Ghana cedis. The company has decided to make a right issue of 1 for 5 at 1.5 Ghana cedis. Okay, let's calculate the total value of the shares of the company after the right issue. So if you are calculating the value of the company after the right issue, value of the company after the right issue is like this. What is the value of the existing shares? The existing value will be 20,000 times 2. Am I correct?
Yes.
And that will give us 40,000. Okay.
40,000.
If you come to the right issue, what will be the amount that we'll be getting from the right issue? Would that be 1/5 times 20,000 times 1.5. Am I correct with that?
Hmm. One is we're not too sure. Let's continue.
We're not too sure. Okay, the right issue is 1 for 5. It's the same thing. Bring the 5 of your existing shares and take 1. So 1 over 5 times the shares over here will give you the right issue shares. Then 1 share is 1.5 Ghana cedis. So we multiply. So the number of shares that you'll be getting will be 1 over 5 times what? The 20,000. That will give you 4,000 shares. Then each share is 1.5. Then you multiply and get a value. What are you getting? Would that be 6,000? Oh, my people, would that be 6,000?
Yes, that's 6,000.
Okay.
Yes, please.
Okay. So the total value after the right issue will be 46,000, isn't it? And the total number of shares will be 24,000. Am I correct? It will be existing 20,000 plus the right issue of 4,000. That will be 24,000, isn't it? All right. Let's now
Yes.
So,
value.
Linus,
Yes, please.
please let's assume that
Yeah.
I'm displaying my ignorance here anyway. So let's assume that we're having the right to issue for 5, and there is a shares of let's say 5,000. So in this case, will it be like instead of the right issue over 1 over 5 will be times 25,000 times the 1.5? Will it be right? 1.5.
No, it will be 1 over 5. You are saying that there was what? We have existing shares before the right issue.
Exactly.
So
Let's
assuming
assume
the existing shares were 20,000.
exactly.
Then they made another issue before the right issue, isn't it?
Yes, 5,000.
Then it will be 20. That will be 25,000.
That will be 25,000.
Yes, please. So the
Okay,
right issue will be made on the existing shares. All right.
Okay. Thank you very much.
But the shares that we have now is 20,000. That's why we are doing the 20,000. The right issue will be made on the existing shares. Okay. So let's now calculate value per share. Can we say the value per share is the 46,000 divided by 24,000? Can we say that?
Yes, please.
And that will give us how much?
1.92.
Okay, 1.9. So this 1.91 or 2 is what we call the theoretical XY price, the actual price of the shares after the right issue. That's what we call the theoretical XY price. We can also calculate it. This is on total basis. This is on total basis. We are calculating the theoretical XY price on total basis. We can also calculate it on unit basis. Mostly you use the unit basis. The question will give you unit basis. Let's come to the existing shares. How many of the existing shares are we bringing on unit basis? How many of the existing shares are we bringing? How many of the existing shares are we bringing on unit basis? No, on unit basis. How many of the existing shares are we bringing? We are bringing 5 for 1, isn't it? We are bringing 5 for 1, isn't it?
Yeah.
Okay. So 5 times 2 is what?
10.
Okay. If you come to the right issue, how many shares are we taking from the right issue? On unit basis, it is 1, isn't it?
Mm-hmm.
And 1 share is what? 1.5. So 1.5 times this is what? Is 1.5. So this will give us 11.5. And the number of shares will now be 6. 5 plus 1, 6. Your theoretical XY price will be calculated as this is just the weighted average number of shares over 6. What are you getting? You get 1.91.
1.91.
Okay. So mostly you use the unit basis. Mostly you use the unit basis. Okay, the question will always give you to use the unit basis. Okay, the theoretical XY price. How do we calculate the bonus issue? We are only concerned with the bonus issue. How do we calculate the bonus issue? The bonus issue, because the shares are going to be issued at a discount, so there's a bonus element there. We first have to find the right issue fraction. We first have to find the right issue fraction. How do we find the right issue fraction? That is the question now. How do we find the right issue fraction? It is very simple. How do we find the right issue fraction? It is very simple. The right issue fraction is calculated as the cum diff price. Cum diff price is the price of the shares before the right issue, which is always the actual price, divided by theoretical XY price. So what the only thing that we need to calculate the right issue fraction is the theoretical XY price, which I have shown over here on unit basis. The question will always give it to you on unit basis. Okay, let's pick the example 2. Example 1 is too simple. Let's look at example 2 there.
Okay. Calculate the weighted average capital in issue on a time apportioned basis. Hey, where am I reading? Okay.
Yeah, example 2 on December
on
31st.
Yeah.
On 31st December 2015, the issued share capital of a company consisted of 4 million ordinary shares of 25 Ghana pesos each. On 1st July 2016, the company made a rights issue in the proportion of 1/4 at 50 Ghana pesos per share, when the shares were quoted at 1 cedi 15 Ghana cedis. The profit after tax for the year ended 31st December 2016 was 425,000 Ghana cedis. The reported earnings per share for the year ended 31st December 2015 was 8 Ghana pesos. Required. Calculate the basic earnings per share for the year ended 31st December 2016, together with the comparative for 2015 that would be presented in the 2016 financial statements.
Very simple. Very, very simple. Very simple, like ABCD. Very simple. Okay. You see, you can see that they have given you 25 pesos and they have also given you 1.15, isn't it?
Yeah.
Okay. We call something par value, which is the nominal value. You see, if you are going to register shares with the registrar general, they will ask you to attach a value to the shares. That is what we call the nominal value. But we use the quoted or the current market price. What we are saying is that the right issue will always be done at what? At a discount. So if you are picking a 25 and the right issue is done at 25 at 50 pesos, are we issuing these shares at a discount? So even if you don't know the value that you are going to pick, the current market value of the shares should be higher than the right issue price. So the 25 over there is a nominal value, it's a par value that was attached to the shares when they are registering it. So we don't take that one into consideration. The quoted market price will be the cum diff X price, or the cum diff price of the shares. The first thing is we have to determine the right issue fraction. The right issue fraction, which is the cum diff price over the theoretical XY price. And the cum diff price is the 1.15. We don't have to do calculation for that. It will always be given to you in the question. But the question now is, how do we calculate the theoretical XY price? Theoretical XY price is calculated like this. Let's use the unit basis. You can see that you are not giving, you are giving the total value of the shares, but mostly if you're using the unit basis, it will be better for you. But you can still use the total basis, but mostly it will be on a unit basis. But if you like, you can still use it. So I'll use that too. Let me use a total approach first. Okay. So what is the shares that we are having currently? What is the number of shares that we are having currently?
$4 million.
Okay. That will be 4 million. And how much are we selling each share? The 4 million, how much are we selling it?
25 pesos.
No, please.
50 pesos.
No, please.
1 CD 15 pesos.
Yes. The 25 is just a nominal value. It's just a value attached to the shares when they are going to register the company. But currently, they are selling the shares at what? 1.15. So we use the current market price, not the nominal value. Take note of that. So 4 million times 1.15. What are we getting?
Linus,
Yes, please.
please, so can you take that again? Can you take why we are using the 1.5 instead of the 25%?
25 pesos.
First was here.
We say that right issue will always be done at a discount, isn't it?
Okay.
Okay. The right issue amount over there is what? 50 pesos.
Mm-hmm.
And you are saying that the market value of the share is 25 pesos. Are you issuing these shares at a discount? That is the first thing that you have to think about. No. The right issue price can never be higher than the current market price. And the 25 over there is just a nominal value. When you are going to register a company with the registrar general, you cannot say that you are going to issue 20,000 shares and that is the end. They have to put a value to it. So mostly it will be 1 CD or 50 pesos. That is a nominal value. But on the current or on the stock exchange market, that is not the value of the shares. But you are just putting that value on the share so that you can be able to what? To put it in your financial statement, or you can be able to register your company. But in the stock exchange market, the value of the shares will differ. And we use the current market price of the shares, not the nominal value. So take note of that. So it will be 1.15, not the 50, not the 25 pesos. What are we getting from this place?
Thank you.
That will be what? That will be how much?
That would be 4,600,000.
Okay, 4,600,000. In what proportion are we doing the right issue? The right
1 for every 4.
1 for 4.
1 for 4. Okay. So 1 for 4. What will be the number of shares that we are making during the right issue? What will be the right issue shares? We currently have 400,000, 4 million, and we are doing 1 for 4. Bring 4 for 1. So what will be the shares? Would that be 1 million? Would that be 1 million shares? The right issue will be 1 million,
Yes.
1 over 4 times. So that will be issued at what? 50 pesos. Are we correct?
Yes, sir.
500,000. So the total value will be 5,100,000, and the number of shares will be what? 5 million. Okay. Let's now find the theoretical XY price. The theoretical XY price will be calculated as the value over the number of shares. So I can see 5,100 over 5,000. What are we getting?
$1.02.
1.02. Okay, this is on total basis. Let's look at the unit basis. Let's look at it. Mostly the question will demand you to use the units. Okay, so the unit, we look at the existing shares, but this will be looked at a unit level. So how many of the existing shares are we bringing? It is 4. At what value? 1.15. So if you multiply, what are we getting? The right issue will be, we are taking 1 share at 50 pesos. So that will be This will give us how much? And this will be 0.5.
4.6.
This will be 4.6. So if we add, what are we getting? The number of shares will be 5. And this will be
5.1.
5.1. So your theoretical XY price on unit basis will be 5.1 divided by 5. You'll be getting 1.02. Are we correct?
Yes.
Okay. Let's come to our right issue fraction. Our right issue fraction will be 1.15 divided by the theoretical XY price. Can someone put that into calculator and give us a perfect fraction?
Linus, please, can you go back to the previous page? I want to look at something, please.
S1.
Are you sure?
Hey, oh, I can't see the figures well.
It's 1.15 divided by 1.02.
1.15
divided by 1.02. Just put it in the calculator. No,
It's
don't,
1.13.
no, don't
1.3.
approximate. If you cannot get a correct fraction, then just leave it like that. Don't do anything to it. Okay.
The line is you prefer the 1.12 than the 1, right?
Which one? This one? Yes,
Yes.
just write it. If the answer is recurring, that is why you approximate it.
No, this one is just 1.12, 1.13.
So I'm getting, if I'm having 1.15
it's
divided by 1.02. I'm getting 1.1274509. You don't approximate. So this one, just
Yeah.
leave this one like this. Pick this one like this. And whatever you want to do, go and do it with this one. Okay.
So we
don't
should
do
leave
it.
it like this.
Yes, just leave it like this.
Okay.
But sometimes you put in the calculator can give you maybe 4/3 or 5/4 or something like that. But since you are not getting anything like that, just use your figure like this. All right.
Okay.
The question
This
now.
one.
Okay. The question now is, what do we do with this right issue fraction? We are calculating the right issue fraction just to know the bonus issue part. What is the number of shares that we are issued as a bonus? So what we do is that the right issue will be done on the existing shares. So let's come to our work. This is how we calculate our work. I will show you so many things over here. I don't want to bother you with how we use the fraction and those ones. You can see that I've listed some steps over there that you can use to do it, but I don't want to bother you with that. Pay attention to this, please. All right. Let's come to the existing shares. The existing shares that we have is what? Is 4 million, isn't it? Okay. It's 4 million. So 4 million. What you do is that you multiply the 4 million by the bonus issue fraction, the right issue fraction. Okay, what are we getting? What will you be getting? If you multiply that, what are we getting?
That will be 4 million.
Oh.
509,000.
Oh, your network.
4509803.92.
Let's make it to the nearest one. It will be
09804.
Okay. So that will be existing shares. If you multiply it to be 4509.
Linus,
Yes, please.
what
Yes.
question is this one? I went off. I'm on it.
It is example 2 under right issue.
Check. I don't know. I'm lost.
Example 2
The
under
question
right
is
issue. Example 2 under right issue. Example 2 under right issue. Can you get that?
okay.
Okay, let's come here. What was the shares at the beginning of the year? The existing shares is what?
4
Yeah.
million.
It was 4 million, isn't it?
Yes.
But after multiplying by the right issue fraction, what are we getting now?
4.5.
Okay, you see the excess on it is the bonus issue. The excess on it is the bonus issue. So what will be the bonus issue here? Will be 509805.
804.
That is the bonus issue, isn't it? All right.
Yeah.
So if you multiply it by the right issue fraction, the excess that you are going to get on the shares at the beginning is the bonus issue. Okay. So if you multiply by the right issue fraction, the excess that you are going to get on the amount relate to the bonus issue. So we are just using this fraction to multiply the existing shares to know the portion that is relating to the bonus issue. I can also show you another way of doing this. Another way of you getting the bonus issue fraction itself is to subtract 1 from this. Let's subtract 1 from this fraction. 1.15 divided by 1.02 minus 1. Do it on the calculator and give me a perfect answer.
That will be 0.127.
Are you approximating? Okay, you can do it as a full answer and multiply it by 4 million, and you give me the what you
That's
get.
1.27.
No, you subtract 1 from it too. It is 1.15 divided by 1.02 all minus 1.
Okay, that'll be 13 over 102.
Okay, 13 over what? 102.
102.
Okay, this is the bonus issue fraction. This is the bonus issue fraction. So what you do is that multiply it by 4 million and tell me the figure that you're going to get.
509,804.
4. So this is a bonus issue fraction. This is a bonus issue proportion. So if you multiply it by this is what you are going to get. So the right issue fraction is just the same as the bonus issue fraction. So if you multiply it by this figure, that is the total value that you are going to get. The value first was 4 million. You are now getting 509,804. The actual figure should have been what? 4 million, but you're now getting 45980. So this is a bonus issue relating to the right issue. The question now is, what is the right issue? A minute. Oh, Jerry? Yeah, there was you. No, I will count like 9 there. I mean, you get a key. So what we go do? Right. The question is, what is the total number of shares that we are going to get from the right issue? What is the total number of shares that we are getting? Is it 1 million? The shares that we are getting from the right issue, is it 1 million?
Yes, it's 1 million because this is 4.
Okay, it's 1 million, isn't it?
Yes,
We
please.
can see that out of this 1 million, 500 and what? 9,804 is bonus issue. So what will be for the full market value? The total shares that we are issuing is 1 million. But out of that, 500 and what? 9,804 is for a bonus issue. So what will be the full market? What is the shares that we are issued for full market value? Let's determine that. So the existing shares will be, let me show this again, will be the 1.15 divided by 1.02 times 400,000 times 4 million, and that will give us 4509804. Let's come to the right issue or the market issue. Okay, so the total shares that we are getting is 1 million, but out of this 509,804 is relating to a bonus issue. So what will be for the market issue now? What is the value of the shares that we are issued at market value? That will be 1 million. That will be 1 million minus what? 509804. What are we getting? I'm getting 490196, isn't it? Is that the case, my people? Is that it? Please, can you hear me?
We can hear you, Linus.
Yes. Would that be the answer?
I was far away from my computer, my distance.
So how are you getting the 490196?
Okay. We agreed that the bonus issue is 5098 something, isn't it?
Yes, sir.
Okay. The total number of shares that we are issuing through the right issue is 144. So that will give us 1 million, isn't it? The total shares that we issue is 1 million. But out of this, 509,804 is for bonus issue. So what is the number of shares that we have issued for a value? That will be the bonus issue subtract from the what? The total number of shares that we are issuing to the right issue. So the right issue consists of a bonus issue and a full market value. The bonus issue is 509,804. But the total shares that we have issued is 1 million. So what portion is issued for a value? Is issued for a market or for a proceed? So we subtract this from the 1 million, and that is why we are getting this one. Are we okay?
Yeah.
Okay. So let's come
It's correct.
The right issue was made on which date? The right issue was made on which date?
1st July.
On 1st July.
Okay. So it means that this full market value was made on 1st July. So this will be used for what, 6 months? Am I correct?
Okay. All right.
Okay. The bonus issue will be from the beginning to the end because we are making the bonus issue on the shares at the beginning. So the bonus issue will be deemed as has been an issue since. But it is the full market value that we pro rata. So the 4901196 will be issued at a full market value, which has been issued on 1st July. So that will be used for only 6 months. So that will give us what? I'm getting
245,098.
98. Let's add.
Yeah.
What will be our work? What will be our total number of shares? Plus 409,804. I'm getting 4754908. 902 rather. So our basic earnings per share will be, what is the profit for the year? It is 425,000. 425,000 divided by 4754908 shares. What are we working? I have some few minutes. Let me do this one, then we move on. We close. Okay. 54902 times 100. 8.94.
Yes.
Okay. So this is all about the right issue. What you have to do first is that find the right issue with fraction. Use the fraction to multiply the shares that will be affected with the right issue. So if you multiply, the increment is the bonus issue. So you ask yourself, what is the total number of shares that you are issuing from the right issue? So if I'm issuing 200,000 and 50,000 is for bonus issue, it means that I'm issuing the remaining 150,000 at the market value. And this will have effect from which date? The bonus issue date. So the bonus issue consists of, the right issue consists of a bonus issue and a full market value. So at that date, separate the bonus issue from the full market value. It is the full market value that we are going to pro rata. The question is saying that the reported earnings per share for the year ended 31 December 2015 was 8 pesos. That is for last year. So what do we do? Since there was a bonus issue, the bonus issue also affects the last year. So that will be our basic earnings per share for 2015 will now be calculated as the reciprocal of this fraction. Okay, 1.02 divided by 1.15 times the 8 pesos. The answer you get will now be the correct one, because the bonus issue will be assumed to be in issue sense, which is going to affect 2015, 2014. So we just use the reciprocal of the right issue fraction to get that. Let's come to diluted earnings per share. This is also diluted earnings per share. Diluted earnings per share is not something that is going to happen. We are just trying to create an awareness that, okay, these conditions that are existing right now, if they should manifest in the future, your earnings per share currently is going to be reducing. So from the start, I have said that, okay, you have 6 children and you have 7 houses. So it means that you have given all of them one, and you're also taking one. But you still have a wife who is young and you're also young, you can give birth. The question now is if you should give birth to additional 1 child, or if you should give birth to a child in addition, it means that you yourself, you will not be having a place to sleep. The additional one will come and take your apartment, because you have 6 already and houses are 7. So if you should give birth in the future or in 2 years to come, you are not going to have a place to sleep. So we are just trying to create that particular awareness to you that if you should give birth again, you are not going to get a place to sleep. That is all about diluted earnings per share. The company is having certain things right now. In the future, those things will become what? Equity shares. If those things should become equity shares, what will be the effect on the shares? So we just assume that if these things are going to happen today, what will be the position for the earnings per share? That is about the diluted earnings per share. The 6 children that you have and you are sharing an apartment, assuming you should have 1 child in addition now, you should have 1 child in addition now. What will happen? They are going to take all the 7 apartments and you're not going to have anywhere to stay. That is what we are trying to do. So the diluted earnings per share, we're just trying to create an awareness to the shareholders that these conditions that are existing now, okay, you have convertible instruments, which you are saying that in 2 years' time, the holders of the convertible instrument, they have the right to convert it to what? Equity shares. The question is that if they should convert that particular instrument today, would the earnings per share be the same? No. Or it can be yes. You have given share options to your what? Your shareholders. Warranties that, okay, in 5 years' time, you can exercise the share options. What normally happens is that as the exercise date, the options will be exercised at a price lower than the actual market value. So if the actual market value is 4 cedis, and they are saying that these people are going to exercise the option at 2.5, you can see that they are exercising this at what? 1.5 lower than the actual price. What we assume is that these people, the options are given to them at a bonus. There was a bonus issue in the option, because if there's no bonus issue, the option should have been exercised as the actual market value. But since they have been exercised at a value lower than the market value, there's an issue of what? A bonus issue there. So we take that one also into consideration. So diluted earnings per share is affected by only 2 issues. The first one is convertible instruments. Convertible instruments. And we also have what we call the share options. Okay. If you come to convertible instruments, what you have to do is that they are going to give you a lot of instruments. You have to test them, because we are saying that the earnings per share will be diluted. Diluted means that the earnings per share is going to reduce. The earnings per share is going to reduce. So if they can give you a lot of instruments, at least two, what you do is that you test them one by one. So you find the earnings per share on them one by one. So if, okay, I don't want to go there. If I pick a question, then I will talk about that. All right. The convertible instrument. What will happen is that the convertible instrument, the company will be paying interest on it every year. So if we assume that this will now be converted to equity shares, it means that the company will not pay the interest again. But this particular interest, it is allowable for tax purposes. The company will subtract the interest from their profits before they will charge the tax. But since we are now assuming that the convertible instrument will be converted to equity shares, it means that we are not going to subtract this particular interest from our profit before we pay tax. This interest will now become what? A dividend. This interest will now become what? A dividend. And we are going to pay interest on this, because this will not be subtracted from the profit again. So we are going to pay tax on this particular interest. So if the tax rate is what? 30%, it means that we are going to pay a tax of 30% on the interest, because the interest will no longer be subtracted from profits. So the interest will be included in the profit before we charge tax. So we are charging a tax of what? 70% on, tax of 30% on this. And the 70% of this will be interest savings. The company will not pay that as an interest again. So the convertible instrument, how we calculate the diluted earnings per share is like this. The diluted earnings per share is the earnings plus the notional interest savings. The notional interest savings, we are going to look at how we calculate it. Then we look at the WACC plus the notional shares. The notional shares is when we are converting the convertible instrument to what? To equity shares. How would the conversion be done? The question will always tell you that. Okay? The question will always tell you that. So it is a convertible instrument that will bring additional what? Cash. But the share options will not bring any additional cash. Let's take a question on the convertible instruments. Okay. Let's look at that question there. Example, before we move on to the let's take the example there. The company had 8.28 million shares in issue at the start of the year, and let's look at that.
A company had 8.28 million shares in issue at the start of the year and made no new issue of shares during the year ended 31st December 2014. But on that date, it had in issue 2.3 million convertible loan stock 2016 to 2019. The loan stock carries an effective rate of 10%. Assume an income tax rate of 30%. The earnings for the year were 2,208,000. This loan stock will be convertible into ordinary 1 cedi share as follows. 2016, 90 Ghana 1 cedi share for 100 cedis nominal value loan stock. 2017, 85 Ghana 1 cedi share for 100 Ghana nominal value loan stock. 2018, 80 cedi Ghana 1 cedi shares for 100 Ghana cedis nominal value loan stock. 2019, 75 Ghana 1 cedi share for 100 cedis nominal value loan stock. Calculate the fully DEPS for the year ended 31st December 2014.
Okay. So the question, sometimes the question can ask you, calculate the basic earnings per share first. So let me do the basic earnings per share first. The basic earnings per share will still be your earnings. What is the earnings for the year? That will be 2208,000 divided by the number of shares. That will give us 8282. Is that correct? Is this correct?
Question, please.
Example under the convertible debt, diluted earnings per share under this one. Is that correct? Sometimes the question can ask you to calculate your basic earnings per share. The basic earnings per share is our earnings divided by our shares that we have. So if there's any market issue shares, we pro rata it or we prorate it, but there's no additional issue of shares in this question. So our basic earnings will be the earnings over the shares in issue at the start of the year, which is 8,280,000. So what are we getting here? I'm getting 26.7 pesos. Is that correct? The question can ask you to calculate the basic earnings per share first. It's just the normal calculation because this one this thing is to test your ability to calculate the diluted earnings per share. Let's come to the diluted earnings per share. It's calculated as the earnings plus the notional interest savings. Notional interest over the existing shares plus the notional shares. Okay. Let's come to the convertible instruments. Currently, what is the interest that we are paying on the loan? What is the interest that we are paying on this particular instrument? What is the interest?
10%.
10% times
10.
times 2,300,000, isn't it?
Yes.
Okay. But first, we are paying this as interest. So it means that we are not paying tax on it. But right now, we want to convert the convertible instrument to shares. We are assuming that if this should be converted into shares, it means that we are not going to subtract it before paying tax on it again. So we calculate the after-tax interest. So the tax rate is 30%. We are paying 30%. So the one that we'll be saving will be 70%. So we calculate after-tax interest, which will be the interest multiplied by the what? The after-tax rate, which will always be 100 minus the what? The tax rate. So we are paying tax of 30%. It means that we are keeping what? 70%. So that will give us how much? 0.1 times 2 times 0.7. I'm getting 161,000. Yes, please.
Salano.
Yes, please.
Please, we are using are we using the 0.7 before the tax is 30%? What the 70%? I don't get it.
70% is the same as what? Put it in the calculator. 70% is 70 over 100. Oh?
Mm-hmm.
70%,
I don't understand. Can you explain?
Oh, 70%.
Can you explain it for me?
70% is 70 over 100. Do you have calculator there?
Yes, I said I don't understand the 70. Yeah, the 0.7. I don't understand it.
Okay. Okay. Interest is allowable for tax purposes. It's tax deductible. So the time that it was debt, you are subtracting it from your profit before you are charging what? Your tax. Now you assume that you are going to change it to equity shares. It means that you are not going to subtract the 10% interest from your profit before you charge tax. So it means that the interest is included in the profit before you are charging the tax. So if you are charging tax of 30%, it means that you are paying a tax of 30% on the interest. So this 30% will go to the tax authority. The remaining 70% will be with you.
Okay, thank you.
All right. So I'm getting 161,000. Am I correct? Okay.
Yes, you are.
Let's count to the number of shares that we are going to get from if we are converting. What is the number of shares that we are going to get?
Hello, Linus.
Yes, please.
Okay, so I want to understand something. The after tax percent, how do
Yes.
you get that?
The after tax percent is the interest. If we are not paying tax, is 100%. The interest, if we are not doing anything, it means that it is 100%. But now we are paying a tax of what? 30%.
Of 30%.
So it means that
Okay.
the remaining one will be 70%.
Okay, that's fine. Thank you.
Or you can also do 1 minus T, which is the tax rate, which will also give you the 0.7. All right, let's count to if we are converting these to shares. If you are the holder of this particular instrument, which of the options? When are you going to convert it? When are you going to convert this one? Is it going to be 2016, 2017, 2018, or 2019? When are you going to convert it? Patrick, when are you going to convert that if you are the holder of this particular convertible instrument? They are saying that if you convert it on 2016, you are going to get 90 shares for every 100 nominal value loan stock. So for every 100 of the loan stock that you have, you are going to get 90 shares for every 100.
No, Linus, sorry.
Yeah.
Sorry, can I take it back, please?
Okay.
The interest. How do you get the 8.7?
8.7 where?
You see, the interest is equal to 10% of 2,300,000 times 8.7.
It's not 8.7.
What from
It's
8.7?
0.7.
So that's the 70%.
Yeah, 0.7.
Okay.
Okay. So the question now is, we are saying that 2016, they will give you 90 shares for every 100 nominal value of the loan stock. They are giving you 85, 2017, 80, 2018, and 75, 2019. If you are the holder of this particular instrument, when are you going to convert this particular instrument? Which year?
I think I'll do 2016.
It's not that you think you do 2016. We all do 2016. Okay. So what you do is that you pick the one with the highest one, with the highest number of shares, because we are looking for what is going to make the instrument diluted. So if you are dividing, the shares will be as the numerator. So if you are dividing by the numerator is higher, it is going to reduce the earnings per share. So we always use the highest one. We always use the option that will give us the highest one, number of shares. We always use the option that will give us the highest number of shares, because we are looking for a value that will make the instrument what? Diluted. So let's come here. We are doing this 2016, and they are saying that we are going to give you 90 what? Shares, which is 1 cedi. 90 shares of every 1 cedi shares for 100 what? Ghana cedis nominal value. The question now is, what is the value of the convertible instrument that we have? What is the value? It's 2.3 million, isn't it?
Yes, 2.3.
Okay. So they are saying that bring every 100 of that particular 2.3 million, we give you 90. So the way that you can calculate this is 2.3 million divided by 100 times 90, or 90 over 100 times the 2.3 million. That will give you the number of shares. So bring every 100 of this. How many 100 can you bring from this? And one will give you 90. So we do that and get a 90. So the number of shares is what?
That's 2,070,000.
Okay. 2,070,000 times 90. Okay, that will give you 2 million and what? 70,000 shares. Okay. So this is the shares now. So we can go ahead to find our earnings per share. Or sometimes you can test whether this particular instrument will make our this thing diluted. So you can calculate our diluted earnings per share on this particular instrument separately. So the savings will be 161 divided by 207,000. We can calculate it before we calculate our earnings per share. What are you going to get? We test whether the instrument is dilutive. We test to see whether the instrument is dilutive. That will be 207,000.
0.07.
0.0 what?
Okay.
7.
7.
That will give you 7 pesos, isn't it?
Yes.
Okay, you can see that that is lower than what?
7.7 or 7.8.
Okay, 7.8. 7
Yeah.
pesos. You can see that that is lower than the basic earnings per share, isn't it?
Yes.
Okay, so if this is lower than the basic earnings per share, it means that this instrument is dilutive. But if you should get something like 30 pesos, it means that this instrument is not dilutive. So we don't include it in the calculation of what? The diluted earnings per share. We do this particular checking for when you have more than one instrument. But this one, since it is one instrument, it will automatically make it what? Dilutive. So our diluted earnings per share will now be calculated as our profit, which is 288,000, plus our interest savings, 161,000. Okay. Then, because we are going to save this interest, it's going to increase our profits. Then divided by the shares that we have, 280,000, plus the shares that we are getting from this place, which will be 2,070,000. What are we going to get for the two? Let's add the top and then the down. 2,208,000 plus 161,000. 2,369,000 divided by 828,000 plus 207,000. I'm getting
350,000.
350,000. So what will be our earnings per share? The diluted earnings per share will be 369,000 divided by 1035,000.
2.3.
22 point what?
No, that is 2.3.
Are you sure? Check it well. 2,369,000 divided by 10,350,000. I'm getting 28.
That will 0.2. Okay. 22.9.
Okay, it's not percentage, it's GP. Okay, so that is all about the diluted earnings per share. It can be convertible instrument. Convertible instruments, you have to know that there will be interest savings. Then you look at how you convert the instrument and what will be the shares that you are going to have. Let me do the share options. Then we solve one major question on diluted earnings per share. Then maybe I'll bring the remaining question in revision. Okay. Let's come to share options. What we are saying is that share options are something, they are rights given to the people or warranty, or it's just like a warrant given to them that at this date you can take these shares, you can buy additional shares. But what is going to happen is that share options will always be given at a price lower than the market value. So if the market value of the shares is 4 million and we are now giving the shares to them at 2.5, it means that we are giving the shares to them at a bonus price. So the bonus issue will now be 1.5. So the question is, what is the shares relating to what? This 1.5 that we are giving to them for free. We want to find a bonus issue relating to that particular share. That's what we do. Share options does not bring in any cash. So automatically, share options is going to make the instrument dilutive because there will not be any additions to the to the earnings. because it doesn't bring in any additional cash. Share options does not bring in any additional cash. Okay, so let's look at a question under the share options. Example there.
On 1st January 2016, the company has 4 million ordinary shares in issue and issues options over another million shares. The profit after tax for the year attributable to ordinary shares is 500,000. During the year to 31st December 2016, the average fair value was 3 cedis, and the exercise price for the shares and the option was 2 cedis. Calculate the fully DEPS for the year ended 31st December 2016.
Okay, so in actual sense, if the shares are to be exercised, what should have been a value? The actual value should have been what? The actual value should have been what? Would it be 3 cedi? If the people, or if we are selling these shares, these options now, it should have been sold at 3 cedis, isn't it? 3 cedis per share, or 3 cedis per option, isn't it?
Yes.
But we are giving it to these people at what price?
That's 2
2
cedis.
So you can see that we are giving them some shares for free, which is 1 cedi, isn't it?
Yeah.
So that 1 cedi represents a bonus issue. So we want to find out the number of shares that we are giving to them for free, which is relating to the 1 cedi. That is the right option. That is the option. So the option is calculated as the earnings attributable to the ordinary shareholder divided by the what? The existing shares plus the what? The bonus relating to the what? To the option. So diluted earnings per share, and the option is calculated as the earnings divided by the existing shares plus the what? The options, which is the bonus option. Okay. So let's come here. What is our earnings per share for what is our earnings for the year?
Earning per the year is 500,000.
Okay. So our existing shares is what? How many shares do they have there?
The existing share is 4 million.
Okay. That is 4 million. Okay, then let's now calculate the option, the bonus relating to the option. Okay. What is the option? What is the total value of the options given to them?
That's 1 cedi.
No. Read that one. Issues options over another million shares. Okay. The share options are 1 million. Okay. So we are giving them another option, which is 1 million. So the company has an issue and issues options another million shares. So the options is 1 million. Okay. But the actual price of the shares is 3 cedi. But we are giving it to them for what? 2 cedi. It means that we are giving 1 cedi for free. So let's find the value of the shares relating to the 1 cedi. That will be 1 over the 3, which is the total price, times the 1 million. What are we getting? That is how we calculate the bonus issue. So the 2 over 3, that is the one that they are paying for. They're not paying for the 1. So 1 over the total market value, or the actual market value, times the option. What are we getting there?
I'm getting 3.3.
Okay, let's just make it 333.
So it will be 333,333.
Okay, 333,333. Okay, let's just make it like that. 3, 3, 3. The 3s are 6. Okay.
Yeah.
Okay. So this is how we calculate our diluted earnings per share. Option, there will not be any additional earnings coming in. There will not be any additional earnings coming in. So what will be the answer here? Let's pull that. Then we look at tutorial question 17. Then we close for today. There are a lot of questions here, but I will bring two of them, especially question 8 and 9. In the
Sir,
yes, please.
please about the calculation for the convertible instrument. The figure gotten there, I'm not really getting it. For the diluted earnings per share.
Or which one?
The weighted average shares plus the notional shares.
Okay.
Like the total there. I'm not getting that total.
Which total?
The 828,000 plus.
It's not 828,000. It's 8 million.
Oh, okay. All right.
8,028,000. Okay.
Thank you.
So what will be the diluted earnings per share for this? Then we go to question 17. Tutorial question 17. It's 9. Let's finish that. Tutorial question 17.
11.54.
11.54 GP. Don't go and do 0.11. This is calculated in the lowest denomination. So if you are getting,
multiply by 100?
yes, multiply by 100. Don't go and do 0.5 Ghana cedi. No, we calculate it in the lowest denomination. So if it is 2 cedi already, don't multiply by 100 and get 200 pesos. No, we only do it when it is decimal, like 0 point something. Then you change it to pesos. But if it is already in cedi, you don't do anything. Okay, let's take the question 17 there. Question 17.
Tutorial question 17.
Yes, please.
The Lynx has 12 million ordinary shares and 4 million 5% convertible bonds in issue as of 31st December 2002. There have been no new issues of shares or bonds for several years. The bonds are convertible into ordinary shares in 2004 at the following rates. At 30 cedis shares for every 100 cedis of bonds if converted at 31st December 2003. At 25 shares for every bonds if converted at 31st December 2004. There are outstanding share options on 400,000 shares, which can be exercised at a future date at an exercise price of 25 cedis per share. The average market price of shares in the Lynx during 2003 was 40 Ghana cedis. Total earnings for the year to 31st December 2003 were 36 million. Taxes payable at a rate of 30% on profits. Required: compute basic earnings per share and diluted earnings per share for the year ended 31st December 2003.
Okay, so looking at this, what will be the basic earnings per share? How are we going to calculate the basic earnings per share? It will be the earnings for the year over the what?
So you only hear the one reading.
It might be your network.
Yes, your network.
So look at the question. Question 17, tutorial question 17. Okay. So how do we calculate our basic earnings per share? This one is very simple. Basic earnings per share. It will be earnings over the number of shares. So that will give us how much? The earnings is how much for the year?
36 million.
36 million. Okay. Our number of shares is what?
12 million.
12 million. So those convertible and share options only affect the diluted earnings per share. So the earnings per share, if you have a bonus issue, a full market value issue, or a right issue, that is why it will affect it. If there's nothing like that, the earnings per share calculation is straightforward. The earnings over the number of shares, that is all. The convertible and the share options will only affect the diluted earnings per share. So the question will come, they will ask you to calculate earnings per share. Is the basic one. The earnings divided by the number of shares at the beginning. Or if there is any full market value, then you now what? Weighted average the what? The shares. And that will give us how much? How much are we getting?
3 cedis.
That will be 3 cedi per share. Then let's now count to a diluted earnings per share. Okay. A diluted earnings per share. We know the formula already. Then let's take our what? Our earnings per share is 36 million plus the notional interest will come. Then we now have, we now have our 12 million shares. Then we add our convertible. If we are converting it, how many shares are we going to get? Then we also add the share options. So let's do our workings here. Let's do our workings here. So the first working, let's do it for the after-tax interest. After-tax interest. Okay. What is the percentage of the interest? What is the percentage of the interest that we are paying on the convertible instrument?
30.
No. The interest will always be the percentage attached to the instrument.
5%.
So we are paying 5% on that. That will be 0.05 times, what is the value of the instrument? 4 million.
4 million.
4 million. Then that will be multiplied by 0.7. The tax is 30%, and we are going to be keeping 70%. So what will be the after-tax savings there? 0.05 times 4 million times 0.7. I'm getting 0.14 million.
Yes.
Okay. Let's come to the number of shares that we are going to have if we convert. On what date are we going to convert? We have 2 dates there. Is it going to be 2003 or 2004? 2009 what? Who is saying the 4?
2003.
2003.
Yeah, that is the one that you guys are number of.
The highest.
Okay. So what will happen is that we have 4 million. We are going to have 4 million divided by what? 100. They are saying that we should bring 100, every 100 of these for 30 shares. So we multiply by 30. Or 30 over 100 times 4 million. What are we getting?
$1.2.
Okay. So that will give us 1.2 million shares. So the interest will now be 1.14 million. Then the shares will be 1.2 million. You can see that we have options there, isn't it? So let's look at the bonus part of the options. What is the market value of the shares? What is the market value of the shares? What is the market value of the shares? Read from the option side there. What is the market value of the shares?
40.
It's 40. But what is the exercise price?
The exercise price is 25.
It's 25.
So what is the bonus? What is the bonus amount?
15.
So 15 over 40 times the options. That will give us
15.
okay. So 15 over 40 times the options. That will give us the shares that we are giving to them for free. Okay. That will give us how much?
That'll be 1.5.
No, that will be 150. So that will be 0.
It's 1.5.
Are you sure?
Yeah, it's 1.5.
we are doing it in million. This figure over here is 400,000. The option is 400,000. No, don't. The option is 400,000.
Okay.
They are outstanding share options on 400,000 shares.
Okay. So 150.
So that would be
0.15.
0.15 million. So this will now be added to the 0.15 million. So let's now find our diluted earnings per share. 36 plus 0.14 divided by 12 plus 1.2 plus 0.15. 36.14 divided by 13.35. I'm getting 2.71.
Yes, that's it.
Okay, so that is the diluted earnings per share. Very simple.
Everything is simple for Linux. It isn't easy.
Okay, so the questions are plenty, but I will try. Maybe, the corporate reporting people, can we do something on Wednesday? I want us to do complex groups on Wednesday.
Yes, we are ready.
Tomorrow we are doing lazies. I will bring lazies. So I will share the notes on the page. Or the lazies, I can do it maybe. Corporate reporting people, I want us to finish on Sunday. Maybe we'll do first subsidiary on Saturday, then Sunday we do console, then we done. Then we just think about revision. Yeah. So maybe tomorrow I can just ignore the tomorrow so that Wednesday, Thursday we do lazies. Wednesday we do the complex groups. Then Thursday we do lazies. Then the Friday we continue with the lazies again.
I think that will do that. Maybe tomorrow we revise these things.
Yeah, the earnings per share there, it is likely that it will come. So you just have to
We have to sit on it.
Yeah. I will still solve some 2 questions maybe during the listing.
So that means tomorrow will be free.
Yes, please. Yes, please.
That is okay. Thanks.
All right. So I will see people when you see me. All right.